There are 3,768 ETFs available in Europe, so which are the best for investors in 2026? I've invested over 600 million euros in ETFs and index funds as the former CEO of Indexo, a European investment company which today is listed on Nasdaq Baltic. In this video, I will show you the most promising ETF strategies that I see right now. But why do I say strategies? Why not just tell you the single best strategy? The problem is nobody, not Warren Buffett, not Ray Dalio, and certainly not me, knows which exact strategy will perform the best over the next 10 years. But you don't have to pick the perfect strategy to be successful with investing. You simply need a good strategy. And based on decades of market data, that means diversification, it means low costs, and it means a strategy that you can believe so that you will stick with it even as the market goes up or down. Okay, so strategy number one is the plain vanilla ice cream of the investment world. With this approach, you're not going to get the most amazing results, the highest possible profits, but you are very likely to get satisfactory results. This strategy is maximum diversification. Let's say you don't have a strong opinion about which global region or which industry will do best. So you put a bit of money into everything. You buy an all-world stock ETF. This combines developed countries like America and Germany and Japan and Australia and emerging markets like Brazil, India, China, and others. Today, investing in an all-world portfolio is super easy. You can buy a single ETF, like the Vanguard FTSE All-World Accumulating ETF or the iShares Core MSCI All-Country World Index ETF. Now, before you rush to buy these ETFs, you do have to check some technical things like should you buy an accumulating or distributing ETF, a physical or synthetic ETF, a Luxembourg or Irish fund, and which brokerage should you use? I will address how to handle these questions a bit later in the video. But for now, let me highlight a potential problem with this first all-world strategy. Over the past 15 years, one stock market, America, has outperformed all others globally. For example, since 2010, the S&P 500 has earned an average of 14% per year compared to just 7% per year for the MSCI Europe stock index. As a result, the US stock market is today 61% of the global market by size. A lot of experts say that that is justified because the US is home to many of the world's biggest global corporations. But to many European investors, it seems like a problem because more than half of your money ends up in a single country. Beyond the financial risks, beyond the large exposure this gives you to the US dollar, this also means political risk. For example, in 2025, the Trump administration threatened to raise taxes on European investors, and this might happen again in the future. This is why some investors today prefer strategy number two, which is a global portfolio with a home bias. Here's what that means. Instead of just buying an all-world ETF, we add a bigger emphasis on your local country or region. If you live in the UK, this could mean putting 20 to 30% of your money into the UK stock market and 70% into the rest of the world. If you live in Germany, maybe you put more of your money into the German market. Or you could take a more diversified approach and put 30% into the entire European area and then 70% into the rest of the world. So if you want to do that, how do you accomplish this with ETFs? Well, you could use a combination of an all-world ETF and a European ETF like the iShares Core MSCI Europe UCITS ETF. But to figure out the right allocation, how much to put into each of these two ETFs, you will need to do a little math. That's because when you buy an all-world ETF, it already invests around 14% in Europe. I won't bore you with the details, but today, if you want your total European exposure to be 30%, you would need to invest around 19% in a European ETF and 81% in an all-world ETF. Now, the benefit of the home bias strategy is that part of your money is invested closer to home, so it should be much better protected from political and geopolitical risks. Also, you reduce the currency risk in your portfolio. But the drawback is that more of your wealth is concentrated in a smaller stock market. Plus, this strategy is a little less passive because if you want to keep that 70-30 balance over time, you will need to periodically rebalance your portfolio. Next up, strategy number 3. Some European investors go even further, beyond adding a home bias. They don't trust the American administration or the economic system in America at all, or maybe they think American stocks are overpriced. So they ask the question, can you build a good investment portfolio without investing in American stocks at all? Well, on the one hand, there are major drawbacks to excluding America from your portfolio. You're giving up access to the world's biggest stock market with some of the fastest growing companies. That said, you still have 40% of the world's market cap to work with. You can choose from thousands of stocks in many different countries and industries. So yes, you can build a diversified, low-cost portfolio that excludes the US. What is the best way to do it? Well, today there are several ex-USA ETFs available to European investors. Just keep in mind that these are developed market ETFs. So if you want to invest in emerging markets like India and Brazil and China as well, you will need to add a separate emerging markets ETF to your portfolio. And then we come to strategy number 4. Let's say you don't want to exclude the American stock market from your portfolio entirely, but you are worried about the overheated tech sector. Maybe you've heard that 10 big tech stocks like Nvidia and Microsoft and Apple and the others make up 40% of the S&P 500 by size. Maybe you've heard that the prices of these tech stocks are extremely high compared to historical averages. Or maybe you are convinced that there's an AI bubble happening. Can you still invest part of your portfolio in the US stock market while reducing your exposure to these big tech stocks? Well, of course. You could add to your portfolio a mid-cap ETF like this one, which invests in mid-sized American companies, or a small-cap ETF like this one. Or you could use something like an equal-weighted S&P 500 ETF, which makes a much smaller allocation to those big tech stocks. The benefit of this strategy is that you will still be invested in American stocks while reducing your exposure to a potential AI bubble. But there are also several drawbacks. For one, you will miss out if those tech stocks perform really well. And for another, your portfolio can start to get complex, especially if you're combining various different international ETFs with small cap or mid cap or equal weighted US ETFs. So make sure you understand what you're doing. Now, whichever strategy you choose, here is a critically important point. Before you buy a single ETF, you need to take into account your individual goals, risk tolerance, and tax situation. So, first of all, if you're 30 years old and saving for the long term, then you could put 100% of your money into a stock ETF. But if you're getting a bit older, a bit closer to retirement, you might want to balance stock ETFs with lower risk investments like bond ETFs. Second, you need to be realistic about your risk tolerance. Having 100% of your money in stocks can mean very big drops in your portfolio when the market goes down. Can you stay calm if that happens? If not, a lower risk portfolio might be appropriate. And third, pay attention to the tax rules in your European country. Because of tax differences, the best ETFs in Germany can be quite different from the best ETFs in Austria or the UK. And in some countries, like in Spain, you may not want to use ETFs at all because there are advantages for other investments like index mutual funds. So if you live in Europe and are ready to start investing, if you'd like me to show you how to build your own ETF portfolio and select a reliable brokerage and take care of investment taxes, you might enjoy a step-by-step training that I've put together on this topic. Just follow the first link in the description to find out more.